Welcome back to The Informed Trader. My name is Chris, and in today's video we are going to be explaining options trading to the best of my ability to make it simple for you. I believe, honestly, if you can stick with me, you're going to walk away with this understanding options, at least basically. All right, I may not go over all different strategies and things like that, but you will understand options by the end of this video. And all I ask is that you like, possibly subscribe. I'd really appreciate it. We talk about stocks, different ticker symbols every day on the channel, just analyzing the stock markets and the opportunities therein. All right, so let's get into it. To start with, to make things simple, we will discuss normal stock investing. So we'll make this simple. We have a stock, Apple, one share. And the cost of one share of Apple, to make things simple here, would be $100. So we have one share of Apple, which is $100. Now, traditionally, if you were to try to make money in the stock market, you would go ahead and purchase one share, costing you $100. Or you could buy 10 shares, costing you $1,000. Now, after you've purchased this, let's say in 2 weeks' time, one share of Apple becomes worth $110. On your initial purchase up here, you will now have profited $10. If you bought 10 shares, you will now have profited $100 if you choose to sell. All right, so that is traditional stock market investing, to put it simple, to just lay a foundation down for us here. So now that you understand traditional stock investing, obviously if the price goes down for Apple, you would lose your money, but if it goes up, this is the money you would gain. Now, let's look at what options trading is. So options has to do with contracts. Now, contracts is not the shares. Contracts is its own entity. One contract always has to do with 100 shares. So just keep that in mind, 100 shares. Let's say you're looking at a stock and you're anticipating to purchase a stock, but you're a little speculative and unsure, so you decide to go a safer route, which is to purchase a contract. All right, now what a contract does is it gives you the right to buy 100 shares of a certain stock for a certain price by a certain time. Okay, so let's simplify that. Let's say you're anticipating the stock being worth around $105. And let's say the time period would be in 2 weeks. That's your time period and that's your target price. All right, you're anticipating the price of Apple to go to $105 in 2 weeks. So you purchase a contract with a strike price, that's what this would be, the strike price of $105, and it expires in 2 weeks. All right, so that would be the entirety of your contract. Now, what this means is that anywhere in between now, from the time you purchased it, and 2 weeks from now, if the stock of Apple is at $105 or above, you can exercise your contract. Meaning, if Apple actually goes past 105 and hits $110, you can still purchase Apple shares for $105. That is the price you committed to, and that is the contract that you're bound to. Now, you will buy 100 shares for $105, should you choose to exercise the contract. Now, remember, you can exercise the contract from the time you purchase till the expiry date, which is 2 weeks from now. So you say, what's the point of this? The point of this is to make sure that you can purchase the stock at a price you would like in the future, whether it goes up, and if it goes down, you can choose to let it expire, worthless. The choice is up to you whether you exercise the contract or not. Now, every contract has a premium. Think of it as a down payment. All right, you're buying the right. All right, you're putting a down payment on the fact that you want to purchase this stock for $105 anywhere between now and the next 2 weeks. So let's say the premium for this contract is $1. Now, this would be per share, because when you purchase a contract, you are buying the right to 100 shares. So your actual total cost, your total premium to purchase a contract would be $100. $1 times 100, obviously, $100. So let's take, for an example, Apple decides to hit this 110 price. All right, it hits $110. That is the price of one Apple share. You have a contract that you can exercise at 105 and beyond, as long as it's in the money. So then you decide to exercise your contract, meaning I'm going to go ahead and purchase 100 shares for $105. So your total cost here would be $10,500. And remember, you also paid $100 for the premium to own the contract, so you've spent a total of $600 on this transaction, all right? $10,600. Now, the actual worth of your stocks, if the price is 110, like we're discussing, would actually be $11,000. But you only had to spend $10,600 for it because you were able to buy it at this strike price, leaving you, if you choose to sell, with a profit of $400. and that's how that transaction would take place. This would be a call contract because you're anticipating the price of the stock to go up. Now, there are also put contracts. It works the same exact way, except you're anticipating the price to go down. All right, you can make money either up or down. I just showed you an example of a call option. Now, what is options trading? Okay, so this is where you make money without actually involving the stock at all, or owning any shares, or even thinking about exercising your contract. Okay, so now we're looking at the same contract, but in a different context, because you don't plan to exercise the contract. You're just trying to trade and make profits off the premium. Now, let me explain. So you decide to purchase one contract, the same exact one, for $1 per share. So that leaves you with a bill of $100. You now own this contract. Now, if the price of Apple were to go up, the premium that you paid for this contract also goes up. So if Apple goes from $100 to $102, the odds of it hitting $105 becomes more likely. Therefore, the seller will charge more for his contract. So let's say he'll charge $1.10 now. That is what the contract is worth per share now. Let's say the price of the stock goes to $5. The price of this may go up to as much as $2. At which point, you have just made $100. Because if we were to take this, $2 times 100 shares, that's $200 total. You paid $100. If you were to sell your contract right now, you would leave with a profit of $100. Your upfront cost was $100. If the price were to fluctuate by $1, however this works, your profit would be $100. And that's what trading options is. Now, a couple quick things to notice first before we leave here. When you are trading contracts, you're essentially trading premiums, all right? You're not exactly worried about the underlying shares, but also realize that the price of the contract is not just affected when the price of the stock goes up or down. There are four main factors that affect an options price. You have delta, gamma, vega, and theta. Okay, delta and gamma have to do with the underlying price. Okay, the price of the stock. And mind you, we're keeping this simple just so you can get a grasp on it. Vega has to do with volatility. So that would mean if the price of GameStop were to shoot up $100 in a matter of 1 hour, for example, that's extreme volatility. Theta has to do with time decay. Now I'll give you a brief overview of what this means. If you have a contract that is supposed to expire in 2 weeks, all right? Every day you get closer to that expiry date, there's going to be some time decay, which means that what once was $1 may become worth 99 cents, for example. Every day you get closer, it becomes cheaper. Vega, which has to do with volatility, can increase the price drastically depending on how fast a stock is fluctuating. Let's say Apple goes from 100 to 110 in a matter of an hour. This premium may go up to as much as $5 because of the volatility, meaning your profit would be $400 if you were to sell at the peak. That's something that affects the price. And then, of course, the price of the stock will affect the options price. But it's not just, okay, the stock goes up, my contract goes up. All right, it doesn't work quite hand in hand like that. So I hope this breaks it down for you a little bit. And obviously, you can buy multiple contracts to make more money. If you were to buy 10 contracts for a premium of $1 each, then you're going to pay $1,000. But if the price goes up to, let's say, $2 for the contract, you now multiply that by 100 and then multiply that by 10 because you bought 10 contracts. So $2 times 100, 200 times 10, your profit is double. You spent $1,000 and you made $1,000 profit. And that's just basic math, but I just want to kind of show you, obviously, the more stocks you buy, if the price goes up, the more you make. The more contracts you buy, the price goes up, the more you make. So hopefully this just kind of gives you a brief overlook of options trading. I know I've watched a ton of YouTube videos to try to understand it and comprehend it, wrap my mind around it. So I just wanted to make a quick video. If you have any questions, please leave them in the comments. I'll make videos on it. I'll try to reply. Just leave your questions in the comments. Hopefully this is something that you understand. If so, please subscribe to my channel, like the video. Like I said, you're on The Informed Trader. I'll see you next time.